Week 5 Readings: Integrating Accounting with Financial Strategy. This unit will delve into the fundamental concepts and principles of financial management. We will explore the role of financial planning in achieving individual and organizational goals, emphasizing the importance of setting clear objectives and monitoring progress. The core functions of financial management, investment, financing, and dividend decisions will be examined in detail. We will explore the intricacies of capital budgeting, the evaluation of investment opportunities, and the determination of optimal capital structure. The impact of financial decisions on a firm's value and risk profile will be analyzed. In addition, the unit will cover the role of financial accounting in providing essential information for decision-making. We will explore financial statement analysis techniques and their importance for assessing a company's financial health. The evolving landscape of accounting, including the integration of sustainability and technology, will also be discussed. In this topic, we will explore the fundamental concepts and practices that are essential for effective financial management. Our learning journey will focus on understanding financial planning, investment decisions, and the broader aspects of financial management. We will start by delving into the basics of financial planning. Next, we will examine the different types of financial decisions that organizations and individuals face. Our exploration will continue with a focus on capital budgeting, a key aspect of investment decision-making. We will take an in-depth look at capital budgeting, which is critical for evaluating potential investments and making strategic choices. In this topic, we embarked on a journey through fundamental concepts and practices essential for effective financial management. We explored the basics of financial planning. We examined the different types of financial decisions faced by organizations and individuals. We examined how investment decisions shape an organization's growth trajectory. We enhanced our understanding of the importance of risk, evaluating opportunities, and aligning decisions with long-term objectives. We also explored financing decisions, learning the importance of balancing debt and equity, choosing optimal financing sources, and managing capital structure to impact financial health. We examined the impact of distributed profits on investor confidence and organizational stability. Finally, we delved into capital budgeting as a critical aspect of strategic decision-making. This topic will delve into the core concepts and principles of financial management, exploring its role in driving organizational success. We will examine the evolving landscape of accounting, including the integration of environmental and social factors, the impact of emerging technologies, and the challenges of operating in a global economy. This topic will explore the intricacies of capital structure, including the determinants of leverage and the trade-offs between debt and equity financing. We will also discuss the concept of the cost of capital, its calculation, and its significance in investment decision-making. We will examine the role of financial statement analysis in assessing a company's financial health and performance. This literature review and analysis examines the current state of the accounting profession, as well as several themes situated to redefine how the accounting profession interacts with both organizations as well as external partners. As the business environment evolves and changes, reflecting the increasing globalization of business, as well as the changing demands and requirements of stakeholder groups, the accounting professions must evolve and develop alongside businesses. Megatrends such as sustainability, corporate governance, and stakeholder reporting have created an increasingly dynamic, interactive, and fluid business ecosystem that requires both a new model for business practices and accounting procedures. This research reviews the existing literature on these separate fields and links them together to create an academically valid argument for a more integrated accounting function. In essence, accounting and the information and analytic capabilities created by the accounting function seems to be shifting to the role of strategic business decision maker. with relationships pertaining to virtually every business function, as well as existing expertise in quantifying qualitative information, designing metrics and KPIs, and reporting information to management. Accountants link market forces to business decisions that move organizations forward. This literature review and analysis examines the current state of the accounting profession, as well as several themes situated to redefine how the accounting profession interacts with both organizations as well as external partners. As the business environment evolves and changes, reflecting the increasing globalization of business, as well as the changing demands and requirements of stakeholder groups, the accounting professions must evolve and develop alongside businesses. Megatrends such as sustainability, corporate governance, and stakeholder reporting have created an increasingly dynamic, interactive, and fluid business ecosystem that requires both a new model for business practices and accounting procedures. This research reviews the existing literature on these separate fields and links them together to create an academically valid argument for a more integrated accounting function. In essence, accounting and the information and analytic capabilities created by the accounting function seems to be shifting to the role of strategic business decision maker. With relationships pertaining to virtually every business function, as well as existing expertise in quantifying qualitative information, designing metrics and KPIs, and reporting information to management. Accountants link market forces to business decisions that move organizations forward. Keywords: sustainability, CPAs, corporate governance, stakeholder theory, analytics, integrated reporting. JL classification, Q56, G34. 1. Introduction. Strategy represents the organizational decision-making and planning process that guides management teams, as well as organizations, forward for a future period of time. In an increasingly complicated and interconnected business environment, the need for a comprehensive strategic planning process is critical for organizational success. One direct and clear manifestation of the interconnected nature of the global macroeconomic environment is the increasing amount of regulation organizations must contend with. Additionally, and an emerging trend poised to disrupt how business operates in general, is the growing usage and utilization of data in business decision-making. As ever larger quantities of information are readily available to business decision makers, it is logical to conclude that organizations able to most effectively leverage this information are positioned for future success. Financial professionals, specifically the accounting profession, appear to be uniquely situated to capitalize on these trends, and leveraging existing capabilities and talents provides an opportunity for accounting professionals to have a definitive effect on the strategic planning process. Management accounting professionals, seizing on both market trends in general as well as specific trends within the accounting profession, seem to moving upward on the internal value chain. 2. Accounting information driving strategy. Information, particularly quantitative financial information, form the foundation and building blocks of strategic planning and business decision-making. This historical truth is only increasing in importance due to the prevalence and utilization of technology throughout the business process. Information, in and of itself, is of limited use to the organization, but interpreting information and translating it into financial realities are a critical connection that must be made between operations and management. From the evidence and literature presented below, it is apparent that the accounting profession is evolving and integrating these changes in the business environment into changes for the profession. Integrating information, specifically operational information, into the business decision-making process is a megatrend redefining how managerial decisions are made. Accounting professionals can take advantage of both the increasing availability of information as well as the need to leverage this information to create new processes and procedures to best make use of this data, Calkins, 2014. Strategic planning requires that decision makers be able to effectively evaluate the wide variety of options available to them and quantitatively evaluate them, and from expanding operations to expanding markets. Management professionals must be able to glean insights from information created from internal systems. Additionally, accounting methodologies and systems that currently exist can be repurposed and revisited to increase organizational effectiveness. Activity-based costing, which also forms part of the basis for what Calkins, 2014, outlines, can also be leveraged and integrated into the decision-making process. The ability of an organization to track, classify, and use information created, as well as to have a thorough understanding of both revenue and cost drivers, is essential for organizations seeking to differentiate product and service offerings from the marketplace at large. Kalakainen and Nazevic, 2013. The ability of management to identify and categorize which types of activities and business processes have the most bottom-line impact is critical to day-to-day management of existing operations, as well as to effectively ranking strategic options. In either case, the critical decision factors are derived from the quantitative information product by and analyzed by the organization. Accounting professionals, well-versed in interpreting and working with said information, appear to be well-positioned to leverage these trends. Business decisions do not occur in a vacuum and must incorporate feedback and information from an increasingly wide variety of external stakeholders. In addition to interpreting existing quantitative information, the finance function, and accounting in particular, are well-positioned to serve as interpreters of external information as they pertain to managerial decision-making. Capitalizing on several external megatrends, namely the rising importance of both governance and sustainability, appears to offer clear opportunities for accounting professionals to leverage existing capabilities and move upward along the value chain. Smith, 2014. Along with these specific concepts and ideas is the concept of a more stakeholder-oriented business and reporting process. Stakeholder theory requires organizations to become more adaptable to the business environment around them, to incorporate feedback and information from stakeholders, and to build these inputs into the strategic planning process. Stein-Smith, 2014. Strategy and strategic planning, in essence, are a stakeholder-oriented endeavor, a broad plan and set of objectives that position the organization for success in an environment regulated, evaluated, and filled with a large number of external stakeholders. Accounting, virtually by default, is evolving ever closer to a role of strategic planning partner due to these changes in the business environment. Several areas in particular stand out as specifically important, and these must be examined in additional detail. 3. Governance. Governance represents both a critical part of strategic planning as well as key element of management itself. Corporate governance, in essence, is how the management team of an organization manages its affairs and interacts with the external stakeholders necessary to implementing the strategic objectives of the organization. Like every other decision-making input, in order to successfully execute and operationalize corporate governance, the management team must be able to examine, rank, and compare information against benchmarks and competitive peer groups. The accounting function, well-versed in quantifying information from the market, appears well-positioned to seize on this opportunity for further expansion and utilization of governance as a strategic planning tool. Strategic planning, in short, represents the long-term objectives and goals of an organization framed against the construct of internal and external pressure that can force organizational change. Integrating corporate governance, which incorporates the dealings management has both internally and externally, with the strategic planning process, establishes a mutually beneficial relationship. M.F. Saltagi, 2013. The importance of corporate governance, with examples ranging from Alibaba, eBay, Apple, IBM, and PepsiCo, is difficult to understate. And the creation and development of marketplace actions such as GMI ratings are another reinforcement of the importance of this trend. Governance, however important to the operations and continued success of an organization, is virtually always described in qualitative terminology. A challenge, one that the accounting profession appears well situated to accept, is how to quantify and standardize the measurement of governance attributes. Embedding accounting personnel and methodology is linked both improved governance as well as the integration of governance and strategic planning, Ratnatonga and Alam, 2011. Connecting these field ideas, corporate governance, and the concept of a more integrated and strategic accounting function is a clear step forward in the evolution of the accounting field. Accounting tools and methodologies, as an extension of strategic planning, already exist and are relatively common. Monte Carlo simulation, real option analysis, net present value, and cash flow analytics are routinely performed as a critical component of the evaluative stages of strategic planning. Against this framework, it is clear the embedding management accounting policies and procedures into the strategic planning process is an effective use of said policies, as well as a logical use of existing organizational talent, Scarebeak, and Trigastad, 2010. Strategic planning encompasses large areas that overlap with corporate governance, and managerial decision makers must be able to address concerns, inputs, and requirements from a large number of external factors in order to plan and strategize effectively. These requirements, and strategic planning in general, require a more holistic view of thinking about organizational performance, i.e., integrated thinking, Tilly, 2014. Underpinning the growing importance of corporate governance and strategic planning is the growing importance of stakeholder theory and engagement, but theory is not sufficient in and of itself. Leveraging accounting capabilities, specifically the ability to create key performance indicators, develop reporting and assurance standards, and translate qualitative market information into quantitative business ideas, are clear linkages between corporate governance, strategic planning, and the accounting profession. The underpinning concept of stakeholder theory, however, provides the foundation and framework from which this debate and conversation can be held constructively. 4. Stakeholder theory. Stakeholder theory and stakeholder engagement represent a dramatic shift in the orientation of strategy and strategic planning. Instead of focusing exclusively on financial shareholders and debt holders, managerial decision makers and the strategic planning process must focus on requirements and inputs from a broad range of financial and non-financial stakeholders. Integrating large amounts of information, translating qualitative information into quantitative business concepts, and developing metrics and processes represent traditional areas of strength within the accounting function that can be leveraged into new and innovative areas. Stakeholders encompass a broad range of possible actors, such as environmental groups, regulators, supply chain partners, and internal employees. Innovative strategic thinking and planning requires that both the obligations and possibilities embedded within stakeholders are fully incorporated into the planning processes, Garriga, 2014. Valuing stakeholder contributions to organizational effectiveness, in essence, represents an attempt to quantify qualitative information and create standards and metrics. Concerns and concepts such as this are not merely related to academic discussions and debates, and issues of stakeholder engagement factor into real-world business decisions as well. Dependent on the specific stakeholder group analyzed, the variation in the degree of pressure brought on the strategic planning process can be significant, specifically with regard to innovative and possibly untested concepts such as sustainability and innovative corporate governance, Fernandez-Fejo, Romero, and Ruiz, 2014. Managerial decision makers, cognizant of an increasingly complex business environment including stakeholder groups, must be able to effectively evaluate the impact of such stakeholder actions. A direct linkage between stakeholder theory, strategic planning, and accounting professionals is the creation and development of an integrated financial report. Spearheaded by the International Integrated Reporting Council, IRC, an integrated report, IR, integrates a stakeholder-oriented approach to business decisions to the financial reporting process. IR expands and builds upon the convergence of marketplace trends such as governance, sustainability, and stakeholder theory while presenting such non-traditional information in a format that is familiar to the marketplace. Roth, 2014. Miscommunication of information to the users of financial statements, particularly as it relates to non-traditional information, can have detrimental effects on both performance and reputation. Monterrey, 2014. Developing and implementing an integrated financial report, or non-traditional reporting in general, is an exercise undertaken by a management team that understands the evolving nature of the business ecosystem. It is logical to assign accounting professionals a leadership role in the development of such a report and reporting structure, as creating, maintaining, and disseminating financial reporting is a traditional strength and area of expertise of the accounting function. Incorporating stakeholder theory within this existing framework is a logical evolution of both the accounting function, while simultaneously recognizing the changing nature of the global business environment. 5. A more integrated accounting profession. The business environment continues to evolve, change, and experience disruptions at an increasing pace, and organizations and entire industries have been disrupted in and out of existence due to whether or not these market factors were incorporated into strategic planning. Strategy and the strategic planning process are of the utmost importance for the entire organizations, as resources and initiatives are ranked, evaluated, and embarked upon, in large part, as a result of where these items are in the strategic plan. Accounting professionals, reasonably so, play a critical role in the traditional planning process as creators and communicators of financial information. As the business environment changes and business organizations must evolve, it is logical that the accounting profession will also evolve. Buffeted by an increasing number of external forces, as well as internal forces, to improve profitability. Managerial professionals are under pressure to leverage existing talents, while also incorporating increasing forces to generate positive results. Well-versed in traditional financial reporting and quantitative information, as well as integrally involved in major trends reshaping the competitive landscape, it appears that the accounting profession is uniquely positioned to evolve from a role as guardian of financial information to that of strategic business partner. 6. Conclusion. Strategy and strategic planning requires the synthesis and integration of large amounts of disparate information, and governance, sustainability, stakeholder engagement, and market analytic must be incorporated in the process. Management professionals must have access to the correct quantities of information in both qualitative and quantitative forms in order to make the best possible decisions. Positioned at the nexus of these converging trends, and drawing from both the academic and practitioner literature, are management accounting professionals. Creating and interpreting quantitative information, and specifically analytics derived from advances in technology, form a cornerstone of the accounting profession. In addition to expanding on traditional skills and skill sets, it is important that organizations are able to accurately interpret and utilize information delivered in qualitative manner from stakeholders, as well as governance initiatives. Management accounting, finance in general, and strategic planning are inextricably connected together, and as the business environment continues to evolve, it is clear that accounting is uniquely positioned to evolve into a role of strategic business partner. This article examines the international determinants of capital structure using a large sample of firms from 37 countries. The reliable determinants for leverage are firm size, tangibility, industry leverage, profits, and inflation. The quality of the country's institutions affects leverage and the adjustment speed toward target leverage in significant ways. High-quality institutions lead to faster leverage adjustments, whereas laws and traditions that safeguard debt holders relative to stockholders, e.g., more effective bankruptcy procedures and stronger creditor protection, lead to higher leverage. Here's a concise summary of the article Capital Structure Decisions Around the World, Which Factors Are Reliably Important, by Ozdi Ostakin, Journal of Financial and Quantitative Analysis, 2015. Purpose and scope. The study investigates what factors reliably determine corporate capital structure, leverage, across 37 countries, using a large international sample and dynamic panel models. It also examines how country-level institutional differences, like legal systems, creditor rights, and governance, affect leverage choices and the speed at which firms adjust their capital structures. Key findings. 1. Reliable determinants of leverage. Across countries, the following factors are consistently important for explaining firm leverage. Firm size. Larger firms tend to have higher leverage. Tangibility. Firms with more tangible assets, e.g., property, plant, equipment, have higher leverage. Industry leverage. Firms in industries where peers have high leverage also tend to have higher leverage. Profitability. More profitable firms tend to have lower leverage. Inflation. Firms in high inflation environments tend to have lower leverage. 2. Role of institutions. Institutional quality. Countries with higher quality institutions, better legal systems, creditor protection, efficient bankruptcy procedures, have faster adjustment speeds toward target leverage. Higher average leverage, especially where creditor rights are strong. Shareholder protection. Stronger shareholder rights are associated with lower leverage, as firms rely more on equity financing. Governance and transparency. Better governance, contract enforcement, and transparency generally lead to lower leverage as equity becomes more attractive and accessible. 3. Transaction costs. Debt and equity costs. Weaker institutions are linked to higher transaction costs for both debt and equity. Higher debt costs significantly reduce leverage and slow down adjustment speeds. Adjustment speed, on average, firms adjust about 21% of the gap between actual and target leverage per year. Half-life is almost equal to 3 years. Stronger institutions speed up this adjustment. 4. Robustness. The main results hold across different definitions of leverage, book versus market, and after controlling for alternative explanations. Implications. For researchers, the study provides a robust, global perspective on capital structure determinants, confirming that both firm-level and country-level factors matter. For policymakers, improving institutional quality, legal systems, creditor rights, governance can facilitate more efficient corporate financing and capital structure management. For firms, understanding both internal, profitability, assets, and external, institutional environment factors is crucial for optimal capital structure decisions. Conclusion. Capital structure decisions are shaped by both firm characteristics and the institutional environment. Key determinants, size, tangibility, industry leverage, profits, inflation, are generally robust worldwide, but their impact can vary depending on the strength of a country's institutions. Institutional improvements, legal, regulatory, governance, can lower financing costs, increase leverage where appropriate, and help firms adjust more quickly to optimal capital structures. This topic delved into the core concepts and principles of financial management. We explored the evolving role of accounting, examining the integration of environmental and social factors, the impact of emerging technologies, and the challenges of operating in a global economy. The topic examined the complexities of capital structure, including the determinants of leverage and the trade-offs between debt and equity financing. We discussed the concept of cost of capital, its calculation, and its significance in investment decision-making. This topic will delve into the critical role of financial statement analysis in understanding a company's financial health and performance. We will explore the fundamental concepts of financial statements, including the income statement, balance sheet, and cash flow statement. The topic will emphasize the importance of financial ratios in assessing profitability, liquidity, solvency, and efficiency. We will examine advanced analysis techniques such as horizontal and vertical analysis. To enhance our understanding of forecasting, we will compare quantitative and qualitative methods. The topic will also explore the integration of technology in financial analysis and the challenges associated with data quality and interpretation. What is financial statement analysis? Financial statement analysis is the process of analyzing a company's financial statements for decision-making purposes. External stakeholders use it to understand the overall health of an organization and to evaluate financial performance and business value. Internal constituents use it as a monitoring tool for managing the finances. Key takeaways. Financial statement analysis is crucial for evaluating a company's performance and can aid both internal management and external stakeholders in decision-making. Three main financial statements provide different perspectives on a company's financial health: the balance sheet, income statement, and cash flow statement. Analysts use horizontal, vertical, and ratio analysis techniques to examine financial statements, providing insights into growth trends, structural efficiencies, and financial relationships. The balance sheet shows a company's assets, liabilities, and shareholder equity, providing a snapshot of its financial worth, while the income statement offers details on profitability by analyzing revenues and expenses. The cash flow statement details cash movement from operating, investing, and financing activities, highlighting the company's cash generation and financial flexibility. Investopedia. Techniques for financial statement analysis. Financial statement analysis involves scrutinizing a company's balance sheet, income statement, and cash flow statement to assess its financial performance and business value. This process allows stakeholders to evaluate past, current, and projected financial health, guiding informed decision-making. In general, financial statements are centered around generally accepted accounting principles, GAAP, in the United States. These principles require a company to create and maintain three main financial statements: the balance sheet, the income statement, and the cash flow statement. Public companies have stricter standards for financial statement reporting. Public companies must follow GAAP, which requires accrual accounting. 1 Private companies have greater flexibility in their financial statement preparation and have the option to use either accrual or cash accounting. 2 Common techniques in financial statement analysis include horizontal analysis, vertical analysis, and ratio analysis. Horizontal analysis compares data horizontally by analyzing values of line items across 2 or more years. Vertical analysis looks at the vertical effects that line items have on other parts of the business and the business's proportions. Ratio analysis uses important ratio metrics to calculate statistical relationships. Comprehensive overview of key financial statements. Companies use the balance sheet, income statement, and cash flow statement to manage the operations of their business and to provide transparency to their stakeholders. The three statements are interconnected, offering different views of a company's activities and performance. Advertiser disclosure. Popular accounts from our partners. Understanding the balance sheet, assets, liabilities, and equity. The balance sheet is a report of a company's financial worth in terms of book value. It is broken into three parts to include a company's assets, liabilities, and shareholder equity. Short-term assets such as cash and accounts receivable can tell a lot about a company's operational efficiency. Liabilities include the company's expense arrangements and the debt capital it is paying off. And shareholder equity includes details on equity capital investments and retained earnings from periodic net income. The balance sheet balances assets and liabilities to equal shareholder equity, representing the book value, an important performance metric that changes with financial activities. Analyzing the income statement, revenue to net income. The income statement details a company's revenue and expenses, providing the net profit or loss. The income statement is broken into three parts that help to analyze business efficiency at three different points. It begins with revenue and the direct costs associated with revenue to identify gross profit. It then moves to operating profit, which subtracts indirect expenses like marketing costs, general costs, and depreciation. Finally, net income is calculated after deducting interest and taxes. Basic income statement analysis includes calculating gross, operating, and net profit margins, which divide profit by revenue. Profit margin helps to show where company costs are low or high at different points of the operations. Decoding the cash flow statement, operations, investments, and financing. The cash flow statement provides an overview of the company's cash flows from operating activities, investing activities, and financing activities. Net income is carried over to the cash flow statement, where it is included as the top line item for operating activities. Like its title, investing activities include cash flows involved with firm-wide investments. The financing activities section includes cash flow from both debt and equity financing. The bottom line shows how much cash a company has available. Insights into free cash flow and valuation statements. Companies and analysts also use free cash flow statements and other valuation statements to analyze the value of a company. Free cash flow statements arrive at a net present value by discounting the free cash flow that a company is estimated to generate over time. Private companies may keep a valuation statement as they progress toward potentially going public. Evaluating financial performance, methods, and metrics. Financial statements are maintained by companies daily and used internally for business management. In general, both internal and external stakeholders use the same corporate finance methodologies for maintaining business activities and evaluating overall financial performance. Analysts use data from multiple years for comprehensive financial statement analysis, facilitating horizontal analysis. Vertical analysis helps understand how different statement categories influence results. Ratio analysis isolates performance metrics and integrates data across statements. Below is a breakdown of some of the most common ratio metrics. Balance sheet. This includes asset turnover, quick ratio, receivables turnover, days to sales, debt to assets, and debt to equity. Income statement. This includes gross profit margin, operating profit margin, net profit margin, tax ratio efficiency, and interest coverage. Cash flow. This includes cash and earnings before interest, taxes, depreciation, and amortization, EBITDA. These metrics may be shown on a per-share basis. Comprehensive. This includes return on assets, ROA, and return on equity, ROE, along with DuPont analysis. What are the advantages of financial statement analysis? The main point of financial statement analysis is to evaluate a company's performance or value through a company's balance sheet, income statement, or statement of cash flows. By using a number of techniques such as horizontal, vertical, or ratio analysis, investors may develop a more nuanced picture of a company's financial profile. What are the different types of financial statement analysis? Most often, analysts will use three main techniques for analyzing a company's financial statements. First, horizontal analysis involves comparing historical data. Usually, the purpose of horizontal analysis is to detect growth trends across different time periods. Second, vertical analysis compares items on a financial statement in relation to each other. For instance, an expense item could be expressed as a percentage of company sales. Finally, ratio analysis, a central part of fundamental equity analysis, compares line item data. Price to earnings, PE ratios, earnings per share, or dividend yield are examples of ratio analysis. What is an example of financial statement analysis? An analyst may first look at a number of ratios on a company's income statement to determine how efficiently it generates profits and shareholder value. For instance, gross profit margin will show the difference between revenues and the cost of goods sold. If the company has a higher gross profit margin than its competitors, this may indicate a positive sign for the company. At the same time, the analyst may observe that the gross profit margin has been increasing over 9 fiscal periods, applying a horizontal analysis to the company's operating trends. What is financial statement analysis? Financial statement analysis is the process of evaluating a company's financial health and performance by reviewing its financial statements, including the income statement, balance sheet, and cash flow statement. This analysis involves using various metrics and methods to assess profitability, liquidity, solvency, and efficiency, helping stakeholders make informed decisions about the financial status of a company. Why is analyzing financial statements important? Financial statement analysis offers a clear and comprehensive view of a company's financial health for both internal stakeholders, such as the finance team and business leaders, and external stakeholders, such as investors. This analysis helps stakeholders identify key insights into a company's performance. It also keeps finance professionals and investors informed about business and market trends, enabling better decision-making. In addition, evaluating key financial ratios such as profitability, liquidity, and solvency helps finance teams and business leaders assess resource management and progress toward financial goals. Investors also use ratio analysis to gauge a company's financial health and growth potential for informed investment decisions. The benefits of performing financial statement analysis include informed decision-making. Financial statement analysis provides necessary insights to business leaders for making strategic decisions, such as expanding operations, investing in new projects, or cutting costs. Performance evaluation. Company leadership and investors can track the business's financial performance over time, identifying strengths and areas for improvement. Risk management. By understanding financial vulnerabilities, company leadership can take proactive steps to mitigate risks, such as cash flow issues or excessive debt. Investor confidence. Detailed financial analysis helps attract and retain investors by demonstrating transparency and the company's ability to generate returns. Regulatory compliance. Regular financial analysis and reporting ensures that businesses meet legal and regulatory requirements, reducing the risk of penalties, fines, or reputational damage. Key highlights. One of the main tasks of a financial analyst is to analyze a company's financial statements, including the income statement, balance sheet, and cash flow statement. The main goal of financial analysis is to measure a company's financial performance over time and against its peers. Analysts use data from their financial statement analysis to build financial models that allow them to forecast metrics like revenue, expenses, and profitability. How to conduct a financial statement analysis. One of the main tasks of an analyst is to perform an extensive analysis of financial statements. This free guide breaks down the most important types and techniques of financial statement analysis. This guide is designed to be useful for both beginners and advanced finance professionals, with the main topics covering 1. The income statement, 2. The balance sheet, 3. The cash flow statement, and 4. Rates of return. Analysis of financial statements. 1. Income statement analysis. Most analysts start their financial statement analysis with the income statement. Intuitively, this is usually the first thing we think about with a business. We often ask questions such as, how much revenue does it have? Is it profitable? And what are the margins like? In order to answer these questions and much more, we will dive into the income statement to get started. There are two main types of analysis we will perform: vertical analysis and horizontal analysis. Vertical analysis. With vertical analysis, we will look up and down the income statement to see how every line item compares to revenue as a percentage. For example, in the income statement shown below, we have the total dollar amounts and the percentages, which make up the vertical analysis. As you see in the above example, we do a thorough analysis of the income statement by seeing each line item as a proportion of revenue. The key metrics we look at are cost of goods sold, COGS, as a percent of revenue, gross profit as a percent of revenue, depreciation as a percent of revenue, selling general and administrative, SG&A, as a percent of revenue, interest as a percent of revenue, earnings before tax, EBT, as a percent of revenue, tax as a percent of revenue, net earnings as a percent of revenue. Horizontal analysis. Now it's time to look at a different way to evaluate the income statement. With horizontal analysis, we look at the year-over-year, YOY, change in each line item. In order to perform this exercise, you need to take the value in period N and divide it by the value in period N, 1, and then subtract 1 from that number to get the percent change. For the below example, revenue in year 3 was $55,749, and in year 2, it was $53,494. The YOY change in revenue is equal to $55,749 slash $53,494 minus 1, which equals 4.2%. Analysis of financial statement. Example of horizontal analysis. 2. Balance sheet and leverage ratios. Let's move on to the balance sheet. In this section of financial statement analysis, we will evaluate the operational efficiency of the business. We will take several items on the income statement and compare them to accounts on the balance sheet. The balance sheet metrics can be divided into several categories, including liquidity, leverage, and operational efficiency. The main liquidity ratios for a business are quick ratio, current ratio, net working capital. The main leverage ratios are debt to equity, debt to capital, debt to EBITDA, interest coverage, fixed charge coverage ratio. The main operating efficiency ratios are inventory turnover, accounts receivable days, accounts payable days, total asset turnover, net asset turnover. Using the above financial ratios, we can determine how efficiently a company is generating revenue and how quickly it's selling inventory. We can also use the financial ratios derived from the balance sheet and compare them historically versus industry averages or competitors. This comparison will help you assess the solvency and leverage of a business. 3. Cash flow statement analysis. With the income statement and balance sheet under our belt, let's look at the cash flow statement and all the insights it tells us about the business. The cash flow statement will help us understand the inflows and outflows of cash over the time period we're looking at. Cash flow statement overview. The cash flow statement, or statement of cash flow, consists of 3 components: cash from operations, cash used in investing, cash from financing. Each of these 3 sections tells us a unique and important part of the company's sources and uses of cash over a specific time period. Many investors consider the cash flow statement the most important indicator of a company's performance. Today, investors quickly flip to this section to see if the company is actually making money or not and what its funding requirements are. It's important to understand how different ratios can be used to properly assess the operation of an organization from a cash management standpoint. Below is an example of the cash flow statement and its three main components. Linking the three statements together in Excel is the building block of financial modeling. Cash flow statement analysis. 4. Rates of return and profitability analysis. In this part of our analysis of financial statements, we unlock the drivers of financial performance with ratio analysis. By using a pyramid of ratios, we are able to demonstrate how you can determine the profitability, efficiency, and leverage drivers for any business. This is the most advanced section of our financial analysis course, and we recommend that you watch a demonstration of how professionals perform this analysis. The course includes a hands-on case study and Excel templates that can be used to calculate individual ratios and a pyramid of ratios from any set of financial statements. The key insights to be derived from the pyramid of ratios include return on equity ratio, ROE, profitability, efficiency, and leverage ratios, primary, secondary, and tertiary ratios, DuPont analysis. Example of rates of return and profitability analysis. By constructing the pyramid of ratios, you will gain an extremely solid understanding of the business and its financial statements. The value of analyzing financial statements. Analyzing financial statements is essential for understanding a company's financial position and future potential. It allows corporate finance professionals to uncover patterns and trends, informing strategic decisions and ensuring alignment with financial goals. Additionally, this analysis helps finance teams identify risks early and take corrective actions to maintain the financial stability of their companies. In addition, financial statement analysis is the first step investors take when evaluating a company's profitability and viability as an investment. It provides a clear view of the company's financial health, including profitability, liquidity, and debt management, building investor confidence in the company's ability to generate returns and manage obligations. Ultimately, financial statement analysis guides internal strategies and attracts external investment by showcasing financial strength and resilience. This topic delved into the critical role of financial statement analysis in understanding a company's financial health and performance. We explored the fundamental concepts of financial statements, including the income statement, balance sheet, and cash flow statement. In this topic, we emphasized the importance of financial ratios in assessing profitability, liquidity, solvency, and efficiency. We examined advanced analysis techniques such as horizontal and vertical analysis. To enhance our understanding of forecasting, we compared quantitative and qualitative methods. We also explored the integration of technology in financial analysis and the challenges associated with data quality and interpretation.